Hello, I'm Satya from Seneca College, and I'm here to talk about how technology has been one of the main transformation drivers in the traditional banking business. Today's customers, including myself, want things quickly, easily, economically, and most importantly, digitally. Banks have been finding out that the only way to stay relevant is to adopt the modern tech advances and go digital. And they have been doing this by transforming from traditional branch-based servicing to digital offerings through mobile banking, digital wallets, virtual assistants, and many more. Financial institutions are also increasingly leveraging other modern technologies such as big data analytics, chatbots, and open APIs. Today's banking architecture is based on flexible microservices and highly responsive APIs, which is total contrast from what was used before. And AI is being used from everything from chatbots improving personalization to complex problems such as preventing fraud. So, while there are a lot of use cases, the real reasons they have got the customers hooked are simple. Firstly, customers can now have 24/7 access to their account and do any operations such as transfers and bill payments without visiting the branch. All these paperless processes result in fewer operational costs and savings are passed on to the customer. Finally, digital banks prioritize security at all levels. I also wanted to emphasize the vast benefits that digitalization has brought to the banking industry. Fewer branches mean that only minimum staff is required, and this frees up employees' time for higher value tasks. Imagine relationship managers spending less time collecting customers' details and more time giving advice. Banks have also been able to create personalized banking experience for their customers and, most importantly, gather better customer insights for upselling opportunities. Also, all the modern tech advances such as open APIs and AI ensure fewer errors. All expensive back-office operations have been completely replaced by robotic process automation tools, saving more time, effort, and money. So, money appears to be the constant undercurrent while we talk about digitalization. Let's try to put a number to it to help us imagine how much savings we are really looking at in the next 2 years. A recent study has estimated that aggregate potential cost savings of banks from API application will be $447 billion by 2023. Just take a moment to visualize that number. And that is AI alone. So, it is inevitable that banking is going to continue transforming at a swift rate, and tech-driven transformation is going to become not only indispensable, but rather the norm. Thank you.
When you place an order on an e-commerce platform like Amazon, do you wish banks and other traditional financial institutions could do the same for you, allowing you to process your money without leaving your home? Hello, my name is Xu Xian, and here I'd like to discuss with you the impact of the development of global e-commerce platforms on traditional banking. First, e-commerce has shaken the foundation of traditional banking. Based on the development of information technology, e-commerce uses the network and the client remote devices to carry on the network transactions activities without the intermediary. With lower operating costs than traditional commerce, e-commerce platforms are constantly improving personalized services, enabling better communication between consumers and merchants, and improving user experience. In the past, the financial market information is not equal. The bank, as a social financial intermediary, has absolute information advantage. However, the real-time speed of the internet and the widespread use of e-commerce have made it possible for users to access information without time and space constraints. In this case, the information advantage of traditional banks is being lost. This means that the indirect financing system dominated by traditional banks is gradually being replaced by the capital market. Secondly, E-commerce raises the challenge of the payment function of banks. Since e-commerce adopts B2B, B2C, C2C, B2G, and other modes, banks must break out of the traditional bank-to-bank framework to establish the corresponding payment system and credit system, laying the interface of the payment system on the mobile terminals of users with the help of Internet. In addition, due to the real-time transaction function of e-commerce, banks need to provide efficient payment services and even realize zero-time difference of capital settlement. To meet these challenges, traditional banks must transform to adapt to the Internet age. Banks need to accelerate product innovation to increase liquidity and profitability, thus improving the engagement of existing customers and acquiring new ones. Banks also need to explore the P2P model to provide customers with a more diversified choice of financial products. In addition to traditional branches, banks also need to explore the development of Internet channels and financial business. For example, establishing of direct banks or cooperating with Internet enterprises to strengthen the capabilities of user acquisition and service in the Internet. Thank you.
When was the last time you were lining up at the bank teller, waiting to pay your utility bill? When was the last time you have to use cash for a transaction? Hello, my name is Cindy, and I am Seneca FinTech student. I'm going to share with you how technology has disrupted today's banking system. Technology has allowed new FinTech entries in the industry to have more leverage, offering competitive services, using much leaner system instead of the heavy, labor-intensive legacy infrastructure banks have to maintain and support. Robinhood, a trading platform, which certainly made its name popular due to the GameStop mania this year. This financial app was launched in 2013 and has created many innovations in the investment space. It was the first to offer commission-free trading. It also enabled crypto trading in 2015. The company went IPO just in July, and now the company has valued at more than $40 billion. Buy now, pay later, a new wave has been shaking up traditional credit card business. As a low-commitment, user-friendly, and budget-focused alternative to credit cards, Buy now, pay later has certainly gained favor by young shoppers. The COVID crisis also boosted this industry last year. Buy now, pay later accounted for $24 billion in consumer spending and expected to reach $347 billion globally by 2025. It definitely continued to disrupt traditional credit card network. Another significant disruptor to financial system is giant tech platforms. They already have well-run platforms in place, already have millions of existing patrons, already have unlimited resources. For example, Google already offers financial services in the US. Amazon has been lending to small and medium businesses. Apple now has a shiny new Apple Card. They see the huge potential market and definitely want to step deeper and grab more market share. There are also many other disruptors, such as crowdfundings, P2P lendings, you name it. As we can see, traditional financial systems are facing intense pressure and competition from both fintech startups and also from giant tech firms. They will need to act fast by adopting new technology, fostering new innovation, accelerate digital services in order to survive and thrive.